Welcome to JRBT Tax Talk. I'm Michael Brown. Joining me is James Beard. Today we're going to talk through the American Rescue Plan Act of 2021, which we call ARPA for short. This is the $1.9 trillion COVID relief bill that's been passed into law at this point. As you might imagine, a bill of this size, there's a whole lot to cover. What we're going to do is we're going to quickly hit the tax-related highlights to help you be aware of the changes. We're not going to go into major detail on any of these changes. So if you need more info about this, the changes in the bill, contact your JRBT tax advisor. James, you want to start it off by talking to us about the recovery rebates?
Sure. Thanks, Michael. All right. Well, as you all might have heard about, the recovery rebates for individuals are a big part of this plan. And with that, it is the $1,400 per person, which is coupled with the $600 from December, gets us to that $2,000 that was talked about in all the campaigns. That $1,400 per person actually includes dependents and college students, for all of the you guys wondering about that. The phase out begins at $150,000 for joint filers, $112,000 for head of household, and $75,000 for single filers. You must have a valid tax ID on the tax return to get the credit. And if you don't get the credit payment because either your prior year tax return didn't have the right information on or something happened, you are eligible to claim it on your 2021 tax return.
So James, let me ask you a question. So a difference on this one to the prior one was that you had a different amount for the taxpayers and the dependents, right?
Correct.
We had $1,200 for the taxpayer and $600 for dependents.
Right.
And this time it's the same amount for all of them, right?
That's correct. And the fact that you will also get to include college student dependents on there as well is a big change this time. So that's going to help folks with kids that are still in college that want to claim the credit. Just a nice little boon to get there.
Cool. Thanks.
All right. And then the other big thing that's going to help a lot of individuals is the unemployment compensation extension. It extended the federal weekly supplemental unemployment compensation for $300 all the way through September 6th of 2021. So that extra $300 a week is going to be a nice boon as well. And then for people with AGIs of less than $150,000, they've actually made it where you can exclude the first $10,200 of unemployment compensation on the tax return. And the IRS hasn't implemented this yet. So if you've already filed for 2020, that wasn't on your tax return. As soon as they do, it's supposed to be implemented for the 2020 tax filing season. So you might want to hold off filing if you did have unemployment compensation for the 2020 tax year.
Yeah, that's kind of one of those programming changes the IRS has to make, and that's one of the reasons that they're extending the tax deadline is so that they can make those changes. And they're supposed to come out with some procedure or process for people that have already filed the return that maybe will allow them to accomplish that without having to amend a tax return. So that's to be determined. I'm going to pick up and talk about the changes to the child tax credit. The child tax credit, the ARPA increased the child tax credit to $3,000 per child, and also distinguished that you now get a $3,600 child tax credit for children under the age of 6. For 2021 only, the child tax credit is fully refundable, which means that it doesn't just reduce your tax liability to zero. You can actually get something back if your tax liability is less than zero. Previously, it was up to 70% refundable. For 2021 only, again, they've increased the age of qualifying children to include 17-year-olds. It used to be just that children under the age of 17. They've revised and adjusted the phase out of the child tax credit. So basically, folks who have higher incomes, they've just bumped it up to where more people will qualify. And reduce the phase out. Also, this is very interesting and new. In July of 2021, the IRS is going to begin making advance payments of the child tax credit on a monthly or some other basis based on the 2019 and 2020 tax return information. So that means that taxpayers that have claimed and received a child tax credit, they'll start getting monthly advance payments of that credit. up to 50% of their credit. So checks from the government. If you don't want to receive that, there will be an online portal through the IRS, or at least the bill says there will be an online portal from the IRS. The IRS has to implement it for people to opt out of receiving those advance payments. You'll still get the credit on your tax return. You just won't have received a check in the mail or a direct deposit. And then additionally, like if you have a new child, you'll be able to update your child tax status through that portal in order to adjust the advance payments. This is something very different and new that they're kind of taking out of the tax return and putting into people's pockets early. Not unlike the advance rebate payments that they've been making, that we've now had, and we're in the third round of. Another thing they adjusted was the earned income tax credit. This is a refundable tax credit for low and moderate income workers, people that have earned wages, but not much. They've expanded the eligibility criteria. The maximum credit amount has been increased. There's a whole lot of details involved in that, but just be aware that more people are going to be eligible for the EITC.
Yeah, that's a great benefit. Hopping in here for the next part of this, another nice benefit that they've added is they've expanded the dependent care tax credit. So the dependent care credit is for full working parents, both the mother and father, or the individual claiming the dependent have to be employed and working. And the credit is for daycare or after school expenses, things like that. And the credit is now fully refundable. The maximum credit rate was changed to be 50%. So the income phase out threshold was also increased and the ranges were increased. So the amount of eligible expenses were also increased. So basically they made it easier to claim. They made the amount that you can claim higher, and they made the phase out even higher. So essentially more people are going to qualify for it and they're going to get more money from it. The total eligible expenses was increased to $8,000 and $16,000 respectively for a single child and two children. You can make the maximum number of children you can claim this on is 2. So that means the maximum credits are $4,000 for one qualifying child and $8,000 for a second, if you have 2 children on there. So with that, that's going to be a fairly big change from prior years. And then the maximum amount of the excludable FSA for dependent care has also increased, where it used to be $5,000 total. It is now $10,500 for 2021. So that means if you were taking FSA deductions for your dependent care benefits previously, you used to be able to exclude $5,000 from your wages. Now you can exclude $10,500 from wages. So,
James, I remember when I had dependent care expense and small kids, and there was the $5,000 max on the FSA, and I went, this doesn't go anywhere towards covering my total bill for both of my kids. So I think some people will feel the relief having it doubled, at least for this year.
They'll definitely feel the relief of having it doubled. Do be cognizant of the fact that dependent care FSA will reduce the amount of expenses you can claim for child and dependent care benefits. So if you get the full $10,500, that's going to reduce your maximum $16,000 for two kids, and essentially you'd be able to claim $4,500 or $5,500 of expenses for childcare and dependent care benefits.
Yeah, it's basically one or the other, not both,
right,
or at least exactly. Not total amount. Yeah.
Yep. And then jumping into something that's kind of a benefit for employers and employees both. For employers, mainly it's the credit for paid sick and family leave. The FFCRA credits extended from March 31st all the way through September 30th of 2021. It increased the amount of eligible wages for the credit to $12,000 per quarter. And then there's a whole bunch of technical changes to this credit. Vicki Stallnacher, who's our director of payroll systems, is going to be doing a tax talk on that in the near future to go over this in depth. I'm afraid that if we try to do it ourselves, we'd butcher it. So we'll let her speak to that, because she knows a whole lot more. For the individuals and the people that actually have sick leave, this just makes it more readily available for you to be able to take off and take care of family or yourself if you get sick during this period.
Yep, it provides a good incentive for employers to provide good paid sick leave benefits.
Exactly.
and we want to keep this thing less than 3 hours long, so we won't go into all the details. Another change, and this one is a bit of a something that's intended to be a pay for, something to be a revenue raiser to offset some of the cost of this bill. There's going to be a change starting in 2022 of the payment settlement network reporting. And you may go, what the heck is that? That's when a credit card, your credit card merchant, for folks that have merchant accounts and receive credit card payments, they send you a 1099. Right now, they only send a 1099 if the amount you receive in 1 year is of credit card payments you receive in 1 year is more than $20,000 in dollar amount and more than 200 transactions in a year. And this is a big change because that threshold is going from $20,000 down to $600. So if you receive over $600 in credit card payments, and there's no minimum threshold for transactions. So if you have one transaction over $600, you're going to get a 1099 from your credit card processor. Some people may think, well, that won't affect me at all. However, if you use Venmo, PayPal, and those types or other, quasi credit card type payment arrangements where you're receiving payments for the sale of goods or provision of services, then you will get a 1099, and the IRS is going to expect that to be reported on a tax return somewhere. So informal sales of things the IRS may be trying to match those things up now that may have previously gone unreported. So this won't change anything if you already get a 1099 from your credit card processor. But those folks that do smaller amount of transactions, it will change something. The IRS is trying to capture more unreported income. That's the whole point of that. Do want to point out that it is just for transactions that are tagged as for the sale of goods or services, not for gifts, reimbursements, or personal or charitable payments. So if I pay James a reimbursement for lunch, let's say we split the check on Venmo, and the ones that he received like that over the course of a year was more than $600, he wouldn't get a 1099 for that. But if he's selling used bicycles out of the back of his garage and gets more than $600, he's going to get a 1099. So that's just going to be a difference that some people might get a little surprised by, when they may not currently be thinking about that as income that they may be reporting. The next kind of revenue raiser change is there's a change in the deductibility of executive compensation for publicly traded companies. And we're going to go into zero details here about that because it applies to probably maybe nobody watching this video. So if it does apply to you, give us a call and we'll talk about it. The next change is a change to the premium tax credit, which is a way that people receive a discount through their tax credit for health insurance that they've obtained through the ACA marketplace. So I won't go into all the details, but just let you know that the calculations have been changed so that the credits individuals receive will be increased, and increasing the number of eligible individuals that are eligible for assistance for the premium tax credit. Also, the premiums for the ACA marketplace insurance have been decreased. Additionally, for 2020, there's a way that, and this doesn't affect doesn't affect everybody, but you can receive advanced credits and then make too much money, and then those credits would become refundable. You'd have to pay them back on your tax return. That's how it normally works. For 2020, if you make too much money and those advanced credits are, you have to pay them back, that's been changed. So those will not required to be repaid for 2020. And then also there's a special provision in 2021 where it modifies the advanced premium tax credit for individuals who receive unemployment compensation. So basically making it cheaper for people that had to go on unemployment, making their ACA insurance cheaper.
Right, and not penalizing them with an AGI hit when they calculate the credit repayment at the end of the year for the tax return.
Correct.
Certainly. Well, the next section we're jumping to is the student loan discharges. So I know we've all heard lots and lots about potential student loan discharge and then that brings to mind what happens when you discharge a student loan. Most of the time when you're discharged from a debt, you pay income tax on it. You recognize it as income. But for discharge of student loans from 2021 through 2025, they will be excluded from taxable income. This includes your federally guaranteed loans as well as your private loans. And the only time this is not true is if the discharge of the loan is basically on account of performing services for the lender. So if you are working for a large private bank or do something like that, and they just charge a loan basically for services rendered, that would be counted as income to you. Essentially, it's compensation. Okay.
Or if you have a direct loan from a school and you go to work for that school and they discharge it as part of your compensation.
That's
another scenario where that could happen.
Certainly. So would that apply for any, just thinking about this out loud, Mike, would that apply for any companies that you go to work for that have a loan payoff program? It seems like you'd have to work for the lender.
It's just with the lender. So if I went to work for a company that has a benefit of paying off my student loans, that
likely already coming in your W-2.
That would now be excludable until 2025.
Okay.
But if you worked for the bank that loaned you the money, then it's not excludable. Kind of a weird
spot.
Weird catch there. I don't think that's going to catch many people though.
No, probably not. So they also added a repeal of worldwide interest allocation rules. This really only affects folks that have foreign subsidiaries. And if you've got foreign subsidiaries and this affects you, please call your JRBT advisor. We're not going to go into any detail on that one because it is a very small section of folks that will apply to that will be watching this video. The section 461I loss limitation expiration extended by 1 year. So this is, they basically pushed back the implementation of the excess business loss limitations. And this essentially allows you to speed up deductions that would have otherwise been capped and not allowed you to take as many losses. So this effectively keeps more money in people's pockets right now. This limitation has been suspended until 2022. It was supposed to go into effect in 2018. And so it just keeps kicking the can further and further down the road. This will be great for folks that are, dealing with losses right now, especially during the pandemic that might have had to shut down and eat a whole bunch of losses. This will help you offset taxable income and not be limited in the amount that you can offset.
And that really it expands the ability of, pushing this back expands the ability of people using losses from one business to offset other income.
Exactly.
Whereas that capability would be limited by this section 461.
Yeah, great point, Michael. Great point. Also, we have the targeted EIDL advance grants. If most of you may recall, there were the $10,000 grants that everybody received that applied for at the beginning of COVID. These $10,000 grants are back, and they are targeted at businesses located in low-income communities. These businesses need to have less than 300 employees, and they need to have economic losses greater than 30%. If they do that, if they qualify for that, they can receive a $10,000 EIDL grant to the extent that they have 10 or more employees. All right, it's $1,000 per employee up to $10,000, a total of 10 employees max. And then there's a planned phased implementation of this to ensure that businesses that are the most severely impacted receive the funds first. So be aware that even if you apply for it now, you may not be in the initial phase in, but it could come further down the road.
And it's important to note that when we say low-income communities, it's a qualification based on the census tract that your address is located in. And just so you know, that there are areas of Waco that are included and considered low-income communities, and there's parts of Waco that are excluded and not considered low-income communities. So if you think you might qualify for that, give us a call. And we can run your address and figure out whether you're in an area that's considered low-income community. The next one we're going to talk about, James and I are both going to talk about because it's a big one, and this, I mean, to me, this is potentially the one that has the biggest impact to our clients, potential impact to our clients. It's the restaurant revitalization grants. I can't understate, this is potentially very large for restaurants that qualify. The ARPA creates a $25 billion restaurant revitalization fund, and restaurants that are impacted by the economic fallout of COVID may be eligible for a grant up to $10 million per business to cover eligible expenses incurred from February 15th, 2020 to December 31st, 2021. There's a $10 million maximum per entity and a $5 million, per related entity group, or a $5 million maximum per restaurant location. And there's a long list of what is considered an eligible restaurant. Let's suffice it to say that if you sell food for profit or alcohol for profit, you're probably included. It's pretty extensive. It does include bars. It includes food trucks, food stands, caterers, and most other way that you could describe a restaurant. So it's pretty inclusive. And if you need more details, give us a holler and we can see if you fit inside that definition. So the grants, they're equal to what they're calling the pandemic related revenue loss of the entity. And you calculate that by taking your 2019 revenue, subtracting your 2020 revenue. So the base is really the change in gross revenue. And then you have to reduce it by any PPP and EIDL funds that you received. So if you're a restaurant and you had a substantial decrease in revenue in 2020 related to 2019, that can be a really big number, and could be very impactful for businesses. So don't discount this. And if you've had a decrease in revenue, please do, and you own a restaurant, please do give us a call, or a bar, because this could be really big. So related entities with more than 20 locations are not eligible. So basically, if you own more than 50% of 20 locations, then that group is not eligible. So it is restricted by size. And James is going to roll on and tell us some more details on this.
Sure, thanks. The grant funds have a fairly large myriad of uses. First, you can use payroll, regular debt payments, not prepayment, so you can't prepay your mortgage on this for the next 10 years by using the grant funds. The rent payments, utilities, maintenance, including anything that's related to COVID modifications, supplies, food and beverage costs, supplier costs, operational expenses, sick leave, basically any type of regular business expense that's not trying to game the system will qualify for this plan. So that's a fairly good list that you can get with. First $5 billion is set aside for small restaurants with revenue less than $500,000. So, that's a fairly large group of folks there that's going to be a big benefit for as well. There's another $20 billion awarded by the SBA equitably to entities of different sizes based on gross revenue. So essentially there's going to be a tiered structure of how much is set aside for different categories of restaurants.
I think the way they say that, I think it means, or what I'm reading between the lines and the way they say that is that, you may apply for a grant of X dollars, and the SBA has the discretion to adjust the amount of the award in order to award it equitably to different businesses. I think basically it will probably ratchet down if all the funds become exhausted or there's enough demand that they may adjust the award.
Definitely. And for the first 21 days of the program, the grants will prioritize restaurants owned by women, veterans, or socially and economically disadvantaged individuals. That socially and economically disadvantaged individuals applies to groups like American Indians and, I'm trying to remember the full list of that, but a lot of minority-owned business minority owners there.
If people are familiar with the term 8A groups, that with respect to SBA and federal government contracts, hub businesses, minority-owned businesses, women-owned businesses, and veteran-owned businesses, those are the types that would qualify. There's some specifics in there.
Yep. Thanks, Michael. Applicants must make a good faith certification that the uncertainty of current economic conditions makes the grant necessary to support the ongoing operations. So essentially, you have to certify that you really are in economic trouble and that you need these funds to continue operations. And then you also have to certify that you didn't apply for the shuttered venue grant. That is also one of the new grants that has come up during this. The funds are not to be used for covered uses by the end of the funds that are not used for the covered expenses by the end of the covered period have to be returned. And if the entity permanently ceases operations by the end of the covered period, the funds that are not used for covered purposes have to be returned. So if you make a decision to shut down and you haven't used all the funds given by this grant, you have to return those funds. It'll turn into a loan that has to be repaid. Then we don't know when applications for this program are going to begin. No information on the SBA website yet. It's been announced, but it takes a little bit of time for these things to get codified and get put together. So probably in the next couple of weeks, I'm sure they'll release a target date at some point. But until then, you might just review your books and records and see if you think you'll qualify for it, and then kind of get your calculations ready and go from there.
Right. Congress is good at telling the agencies, okay, go create a program. And this is one of those cases where Congress has told the SBA, go create a program. And so it does take them some time to figure it all out, get the processes in place, get their site updated to where they can accept and, develop an application system and all that. Kind of like we saw with the beginning of the PPP program. It was a slow and jerky rollout. Let's just call it that way. I would expect similar thing with this. It's not as big in scope, but the individual awards could be very significant. So if you own a restaurant or a bar, and your revenue decreased, give us a call and we'll see what we can do to help you get your ducks in a row as far as getting ready to apply for this and getting that information together.
I'd also add that you probably want to monitor it even after it does come out, because just like the PPP, it's liable to change quickly and change often.
Right.
We've had so many iterations of the PPP loans that I would expect a similar program to go through similar iterations to make it more consumer friendly, to make it easier to get, to make it easier to forgive, this, that, and the other. So anytime you hear something new about it, reach out to your JRBT advisor, because we will also be staying on top of it so that we can help advise you guys about the changes that have come up. And just know that if you don't fit in the box at the beginning of the program, doesn't mean you won't fit into that box by the end of the program.
True. Good point. Based on our experience with PPP, it's been a ride. So now I'm gonna play cleanup here and just kind of hit real quickly some of the various and sundry other items that are included in this bill, and then we're going to wrap up. So the ARPA did provide that the tax treatment of the EIDL advances and the restaurant revitalization fund grants, they're going to be treated much the same way that the PPP funds were treated, or forgiveness under PPP were treated. That the money received from those funds and those programs are not included in gross income, and that you similarly will not be denied deductions or have any tax attribute reduced or basis decreased because of the exclusion of the grant funds. So they've used the same language that they did with the PPP funds, saying you don't have to include this into income and you don't have to reduce your deductions related to these funds. A few other just random and sundry items included in this bill are that federal employees that are diagnosed with COVID, they're eligible for workers' compensation benefits. That's just federal employees. COBRA health insurance premiums, if you leave a job and that's the continuation of your health insurance benefits under the employer's plan, those are eligible now for 100% tax credit. So basically your taxes are going to cover your reduction in your taxes is going to cover the cost that you have to pay out for COBRA. They bumped up the funding for PPP, added $7.25 billion to it. I'm not sure if that was based on a projected shortfall or what that was based on, but they've added a little bit of money to it. Not in ARPA, but separately, the House of Representatives has passed a 60-day extension of the March 31st PPP application deadline. It hasn't passed the Senate yet. I just checked it. It passed almost unanimously. I think there were 3 no votes in the House. So it's definitely bipartisan. I would imagine, barring some other roadblock or bump, it should pass through the Senate in a similar fashion. So there's a good chance that the March 31st deadline for PPP applications, which is coming very quickly, will get extended. The last thing on ARPA is that it also expanded the types of nonprofits that are eligible for PPP. And so, James, I think we covered all this in record time. So you want to wrap us up?
Sure. Thanks, Michael. Well, thank you all for joining us today. We appreciate you tuning in, and please do reach out to your JRBT advisor if you have any further questions about anything we've gone over today. I think that about covers it. And we appreciate your time.
Thanks, everybody.